Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
How you doing, Kirk? Are you feeling good again? Everything's good. Everything's behind us. It was all, matter of fact, it was all just a simulation, I think. We just went through. There was a blip in the matrix. I don't know if you saw a black cat repeat itself, as if because you remember that if you see a black cat flip twice, it means they reprogrammed the matrix.
Yeah, I did see that. I saw war in the Middle East twice.
There you go. Obviously, somebody was reprogramming the matrix, so you're gonna have to find a new exit.
Yeah, I mean, we bombed the nuclear plant and tried to get rid of it, and everything was great. And then a few weeks later, we went to war. So yeah. That's the matrix. Now, I just for all those of you tuning in live, this is done on Friday, and apparently the war is over. Which for all intents and purposes, I'm not sure if it is, but the Strait of Hormuz is open, as far as we know, which means that global traffic will be coming in and out of Strait of Hormuz now, we think. But given the fact that the propaganda and the news coming out of the Middle East has been sketchy at best, I'm gonna reserve my thoughts till we're a little bit further down the line. However, the markets seem to agree and seem to like it, so most likely it's the case. But we've been hearing a lot of things up till now that have not necessarily been true, which we've talked about on the show as to how that the fog of war is typically inaccurate. So, the way the market's treating it, it seems like everything's fine, all clear. Strait of Hormuz is open, which is great. It's great for the rest of the world. It doesn't really impact us very much because the things that flow through there, mostly we don't need. Some things we do, but most of it we don't need. The rest of the world needs it. LNG and oil and things like that are really important. There's a lot of countries that are have been having issues. And just to put things in context, I was listening to a great podcast earlier this week, and they were getting into more of the nitty-gritty detail of this, which I didn't know. Which the interesting part is it takes about 6 weeks for the tankers to get to where they're going. So
they don't move
in the next this week or next is when the oil shock really actually hits. So we're still going to have 6 weeks of this, for a lot of countries, and a lot of countries have actually struggled. And, I think we talked about this last time, but there are a bunch of countries from the Philippines to India to South Korea and Egypt to Malaysia, and they've all taken different tacks as to how to handle the fuel crisis. Some are doing subsidies, some are rationing, some have price caps or controls. Demand reduction. There's a whole bunch of things. I'll share a chart here. This kind of shares some of the countries and what they've done. But a lot of the emerging market countries have struggled. Some developed countries, but a lot of the emerging market countries have struggled. And I think the challenge is when you're working with a global economy, many of which rely on the Strait of Hormuz, it becomes a problem. Now, I hope that this is wrapping up, and that they're in true negotiations, not just the BS that we keep hearing. But we don't know. We're not going to know until it's over. At this point, it seems like the market's going up. And I've been watching the market, and everyone's really excited. And yet, the fundamentals haven't gotten any better. And even before the war, things were going in a certain direction. And if you look at before the war, things were doing well were materials, industrials, financials, energy. And none of those are doing well now. Has the economy fundamentally changed to cause those to not do well? Not really. I mean, really nothing's changed. I mean, the war has certainly changed things. Sorry, I'm trying to bring up a chart here. If I look here today, the best performing stocks, I mean, industrials are up 2%. Consumer discretionary is up 3%. Technology's up 1.5%. Healthcare's up doing okay. Utilities are down quite a bit. The staples were down today. Actually, now they're up. Materials are less than 1%. So, if you're looking at this, at the start of today, it looked like the worst performers were industrials, energy, materials, utilities, and staples, which is the exact opposite of what was happening before the war. So I'm very curious to see what happens here. I'm curious to see if the dollar continues to drop, if the trends before the war continue, or if we have new trends where technology is leading again. I don't know why it would, but that may be the case. People might just say, whatever, tech or bust, and just throw all their money in tech, which is where it seems like things are going. Um, I think that's a very simplistic response, and I don't think that'll necessarily be the trend going forward, but it is now. So, you know, when you're looking at these markets, you really have to be nimble. And we talked about last week was patience and caution. Um, this is exciting, but the markets are really overstretched. So when the market bottomed recently, a few weeks ago, it was overstretched to the downside. Now it's overstretched to the upside, and it's doesn't mean it can't keep going up, but it does mean you should use caution. Don't just necessarily jump in willy nilly and put it all in black and say let it ride. Certainly, sentiments out of Washington could change anytime. The market could wake up and say, okay, that's a little too much too fast. A lot of traders I know got out yesterday and just said, all right, we took our profits and we're done. So, there's a lot of people chasing this because they were offside. They were short the market and now they need to cover their shorts and they need to go long. And that doesn't happen necessarily overnight. It could take a week or two. And, it's been about that. So I think at some point we'll see some consolidation and, we'll see either a slight pullback or we'll see it going sideways, both of which would be healthy. And, but the market always tends to do things that the least amount of people suspect, which means it's probably just going to keep going higher and people are going to be chasing it, which is part of the problem. But, it's going to be a crazy year. And so, as I kind of look through the charts and look through a lot of different areas in the markets, I can tell you one thing is that things are very messy. Things are very messy. Like the charts are a mess. There are very few clear charts. There's some of which we were in before the crisis, and we may have to get back in because they've started to go into the direction. But, most of them kind of got messed up because of the war, and it's gonna be really hard to chart that. But some of them are still clean, and ideally, you want to focus on the clean ones. The messy ones, you're kind of guessing. But we had earnings this week. Earnings week we had. I keep getting these calls. So we had a lot of financials this week. We had all the big financials: Goldman, J.P. Morgan, Wells Fargo, Citigroup, BlackRock, Bank of America, M&T, PNC. We had a whole bunch of them. U.S. Bancorp. We had Travelers, Fifth Third. We had a whole bunch of them. So this is typically the financial week. It's usually the first big week of earnings is the financial week. And, next week, obviously you can see here, next week is going to be a very action-packed week. You got some airlines, you got some industrials in there. You got some tech, you got semis, you got Intel, Blackstone. It'll be interesting with the private credit problems. You got some tech, so that'll be this will be a big week too. The biggest week is going to be in 2 weeks, the week of the 27th. That's where you've got all the Mag 7, or almost all the Mag 7. You got Meta, you got Alphabet, you got Microsoft. You got all those in one day. Then you've got Apple and Amazon the next day. So, and you got some of the chemical companies or some of the energy companies. So it's going to be, that's going to be a big week. So earnings season, here's a lesson to take away before we hand it over to Doug is, the thing to watch for earnings season, it's not the earnings themselves. It's how the market reacts to the earnings. So what we've seen, if you're looking at kind of the markets, if you look at, let's say a company comes out with really bad results and the market goes up, that's actually a good sign. It means most of the bad results are already priced in and it was better than people expected. But if they come out with great earnings, the market sells off, that's a bad sign. No, I mean sell off, I mean not similar to what's going on in the market. So the market's, everything's up today, so it's really hard to tell what's not good. But let's just say the stock market's up like 1% today. And let's say ABC Corp comes out with great earnings and the stock's down 1%. Well, that's bad, right? It's relative to the stock market. Now, if stock B comes out and they report and they're up 1%, okay, the market didn't really care too much about the earnings because it's similar to the market, it's relative to the market. Now, if it came out with earnings and it was like up 5%, well, it did great, and the market really likes that. So the way to read earnings is it's how it performs in expectation to the results. If the results are good, doesn't perform well, usually means that the market might be at a turning point for that stock. If it's really crappy results and it goes up, it means they found all the cockroaches and they're like, all right, it's time to go up. So you want to watch areas like that because there are opportunities. Like software is a good opportunity area. It's been selling off huge recently. And there's a symbol IGV, which is the software ETF. That's when you look at, you're like, wow, that's really sold off a lot. And that includes like Microsoft and Adobe and Constellation Software and all these like Salesforce and all these software companies. And it's just been getting taken to the cleaners because everyone's worried about AI. Well, it's gone up a lot in the last few weeks. Do people no longer care about AI? Is AI no longer a problem? These are part of the issues that come up, right? Is these problems haven't gone away just because Trump announced that the Strait of Hormuz is open. Software really has nothing to do with oil. But my point is you want to have a scope of understanding of how things are operating, because just because everything's great, it doesn't mean software is back again. But if it starts to go higher, then people might say, you know what, this is a little overdone. Let's jump in. So this is a time I would not be chasing this unless you're a day trader. I would just kind of take a pause and wait for things to settle down a little bit before you make your decisions. But in general, you want to be watching the markets and how it reacts to certain things, how it reacts to earnings, how it reacts to Trump's message, how it reacts to whatever's going on. Because this is really how you can get a good understanding of the markets. And you get a feel pretty quickly for what's working, what's not working, just by seeing how it reacts to different events. The last month and a half has been screwy. You can't really do much with it because it's just the war just screws up everything. Once it gets back into like a rhythm, it's a little easier to predict trends and patterns and where things are going, and that's really where your best decisions can come from. Because right now the charts are still a mess. And I'll show some in a bit. I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true. You can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today.
Yeah, so kind of in a summary, and I've got some charts I can come back to, but I just want to run through a few things here that I can share kind of more detail. But effectively, what we saw this week is that a week ago when we were talking, the markets were still pricing fear. Today, they're pricing relief. What was interesting is that when we first went into this, to this conflict, we saw the markets pull back. But you and I talked about this; they didn't really pull back that much. Overall, when you look at the general, the average of the way markets pull back, and you look at where the markets pull back in this, we didn't even hit, even though they were overstretched to the downside, we really didn't hit some of the averages we typically hit in a normal market movement year, which tells you that the true, even though they were pricing fear, they weren't pricing catastrophic fear. For whatever reason, you could still see that there was some element of confidence, probably based off of the history, a pattern that we've seen with this administration, that a lot of things get thrown out there and then negotiation tends to occur later. But what we've seen consistently in most of the scenarios that have happened, over recent years, is that when we do hear about geopolitical type of situations or even economic situations, the markets pull back less than they accelerate, right? So what did we see? We saw pricing fear, but now that we've had this tentative, agreement that will remain to be seen, what we've seen now is this acceleration of pricing relief that overblows the amount that it pulled back before, as if nothing ever occurred and nothing changed. But now, instead of just kind of going back to where the markets were prior to this conflict, they've jumped ahead and they hit all, once again, the S&P is at all-time highs. But the data this week is still telling a very different story. If the federal, if you look at federal charts, CPI jumped ahead. Okay, energy was already flowing through the system, and the inflation spike didn't wait for the deal. And I don't expect that we're going to see that it's going to disappear because of it. Ultimately, if we look at what's happening there from an international standpoint. The IMF has been already kind of indicating that growth has been slowing, inflation is rising, and emerging markets pressure has been, is really starting to feel it. We talked about ultimately some of the decisions that emerging markets were making based on it. So the global economy has already started to absorb the hit. The oil shock, it has not fully reversed. It is still elevated. It is still volatile. The markets have moved on, but energy still hasn't. And we're starting to see that the futures have certainly come down from where current Brent prices are, but they're not coming down anywhere close to where the pricing was prior to this conflict. So we're definitely starting to see that there is an impact that was going to remain to be seen. And I joked about it kind of over what you were saying, is that in this 6 to 8 week period that it takes for this for this energy to come through, to come across, for shipping to come across, creates a lag, and that growth hit is likely coming. The economic damage shows up well later. It doesn't have hyperdrive. It's funny because I saw a video this morning on the Millennium Falcon. We don't have that. It still takes time for things to come across. So we haven't felt it necessarily yet. And I'm going to come back and show some charts that can indicate this too. I'm just kind of going high level here, Kirk. But the market right now is still pricing a best case scenario. Goldman Sachs is kind of showing that this rally is assuming that everything goes right. And long term, from these shock factors, we do tend to see a positive outlook that happens over 12 months, months ahead. But again, if you look at some other data, for example, I forget from another, I have to pull it up. But ultimately, they show that these lags ultimately do have an impact on the GDP that's going to happen later. So parts of the system don't necessarily recover quickly. And unfortunately, as you're saying, this is no longer a fear market. It's a misaligned market. The market's already moved forward, but the economy hasn't caught up. So I think, what we're seeing here, Kirk, is that relief came fast, but reality moves much slower than that. So be very careful about where these markets have gone and what these markets are telling you that we're seeing and we're going to experience. When reality comes back in, I think you're going to see a higher probability that that is going to then temper those markets back to, back to the real data. The markets are pricing outcomes, but the economies are absorbing consequences. And the rally is forward looking, but when we get that data, it's going to be more backward confirming. And so we're running on optimism right now, not clarity. And fast rallies like this, they generally ignore slow damage.
It's interesting because I think as people look through the markets, you can kind of learn a lot about how people are digesting stuff. Like as I'm looking at the markets right now, pretty much everything's green except for oil, which is down a lot. It's down like 8% actually. It was down 10 earlier. Looks like the markets are actually turning as we speak, which is interesting. But oil's down today. Brazil's down. Oil service sector, oil exploration and production gas is down. Utilities are down. The energy sector is down. Solana, weird. Some of these are down. The dollar's down. And Argentina, some of the software. I mean, there's some random stuff for down, but mostly everything else is up. And so the interesting thing is when you see days like this, like, all right, look at the screen and see how everything's playing out. And what is this telling me? Like, you want to look for the relative variations. You want to look for the outliers. Like, why is this not up when everything else is up? Why is, everything's up 1%. Why is this only up like, 10 basis points? That stuff matters, right? Like right now, Latin America is only up 0.04% in a really big day where everything else is up. I don't know. It's a good question, right? So all of those things matter. Now, I want to use that to kind of like pivot a little bit into correlations, because I want to kind of go through something here and teach you a little bit about correlations. So this is a correlation graph. Now, if you've never seen one of these, I'll kind of walk you through it. Now, there's two axes, right? The X and the Y axis. On one side, you have equities, treasuries, investment grade credit, gold, dollar, and oil. On the other side, you've got the same things. Now, see here the diagonal line. It's if you look at the horizontal and the vertical, the deep red is 1, and that's equities versus equities. Well, obviously, equities are 100% related to equities, right? Because there's a one correlation, which is the strongest you can get. And then you look at like gold compared to treasuries, there's negative 0.02 correlation. So it's interesting, right? You get to see all these things. Well, prior to the war, right? Prior to the shock, so this is back in February, these were the correlations, right? Investment grade, treasuries, they're correlated to each other. But most of the rest of the market did not have a high correlation. Now, if you look at after the shock, so like March 1st and to present, a lot of things correlated. You looked at equities, you looked at treasuries, you looked at investment grade credit, really high correlation to each other. Now, I point this out because when you're looking at stocks compared to bonds, you would think, well, stocks and bonds operate independently, and bonds are safe and stocks are more aggressive, and that's what you're taught with investing 101 and Vanguard, and all these people teach you this. Well, bonds are safe and stocks are more aggressive, so you got to have both, and they tell you all these things, and it's really not necessarily true. It's partially true. It's sometimes true. So there are times where stocks go up and bonds go down, and when bonds go up, stocks go down. There are times that happens. That is one version of a normal correlation. But there are other times where they move together. One of those periods is 2022, where stocks went down and bonds went down. That doesn't normally happen, but it does happen. And so when you get these shocks, typically come through some sort of a shock that people aren't prepared for. It might even come with a war, or in this case, 2020 was the raising of interest rates. It could be COVID, could be 2008. I mean, if you look at these events where you have this kind of I call it the contagion effect, but basically what it is everybody's selling indiscriminately and they're trying to raise cash, and there's a lot of leverage, and so they're deleveraging, and the deleveraging causes everything to go down, not just money rotating from one place to the next. So typically in a normal, healthy, functioning market, money rotates. It rotates from one area to the next, to the next, to the next. Rotates from stocks to bonds to different sectors to international. Money just rotates. It has to go somewhere, but it rotates. Now, when you have leverage, you could have everything go down together because leverage is being destroyed, right? But if you didn't have leverage and you just had, like, let's say like 100 single dollar bills and they're all floating around, they all go somewhere, right? And with leverage, you've got $200, $300 that floating around, and it changes things. But if you just have no leverage, it's really simple. You just figure out where the money's going. Wherever the money's going is where people think is the most plausible outcome. So the market is really interesting when right now people are trying to add leverage back on because they think the war is over. Maybe it is. I don't know. I just know the Strait of Hormuz is open, according to Trump. We don't know if it is, but at the moment, I'm suspecting maybe it's true. So assuming the war is over or ending, then people are levering back up and they're getting back on the horse and they're just going to go keep riding it higher. But if it's not ending, then we'll see what happens. Could be interesting. So the correlations here, I just wanted to show this because you need to really see sometimes things are normal and sometimes things are completely abnormal. And they don't always look like this, right? This is really low correlations for a lot of these things. It's not always like that, right? Sometimes everything's really highly correlated, even though there's no problem out there. But this is really for people who are asset allocators. Looking at this and understanding this is really important. I don't know if you're going to make any day trading decisions on this, because I wouldn't. It's just something to keep in mind of, hey, things are changing. We need to be on top of this. We need to understand why this is changing, and is this a material change or just a temporary change? While we're talking about correlations, I wanted to share one more. Hand it back to Doug. Let me see if I can get this to rotate. There we go. I also wanted to share this, and I was reading one of my investing books, and this came up, and I thought it'd be good to share. And it's this: is that when you look at stocks, bonds, and commodities, they typically operate within cycles. It doesn't always happen. A war is, I've said this in the past, a war is you just throw out all the rules. There's no rules when there's a war going on. You can't predict. There's no trends. It's just, it's time to just get out of the market and sit on the sidelines generally. But if you're looking at, if you're looking at this in a normal environment, typically bonds lead the stock market. So whatever bonds are doing, they go first. And then stocks go next, and then commodities. So if bonds are going up, they go first. Well, they don't always go first, but if bonds have peaked, they start dropping, and then sometime within, usually about 6 months, sometime within 6 months, stocks start to drop. And then about 6 months after that, commodities start to drop. Now, what I'm trying to share is not that this always happened, because it doesn't always happen. What I'm trying to share is there are normal market correlations that happen in certain ways. This is a normal and highly understood function, but it could also mean that that's no longer working. So you can't always trust it. So these are more like guidelines than rules, right? Because if you look at it right now, bond yields were not necessarily aligned with stocks, which are not necessarily aligned with commodities, right? With the war, like, commodities were going cuckoo and stocks were going the other way, and it didn't act like it normally would. But that's okay. So now that things are getting back on track, hopefully, cross my fingers, things are getting back on track, and we get another few weeks of stability in the markets. you might see markets turning to more normal correlation. Um, I would be very careful about jumping into the markets right now. I think it's way overstretched. We pretty much have gone straight up for the last, is it 2 weeks? Like the last 2 weeks, the market's
Definitely the
pretty
last,
much gone straight up.
definitely the last week for sure. Yep.
Yeah, week, but maybe two. Well, definitely last week, but I think it was 2 weeks. I have to go back and look at the numbers. But basically, the last 2 weeks, the market's been going up, and they've shot up, and definitely in the last week. So, it's gone a little too quickly, too fast. And that's usually a sign of, hey, maybe we'll see things take a little pause here. So I would be a little cautious. I wouldn't get too greedy here. I mean, even today, even when we started this podcast, I mean, some of the areas we're looking at, like, oil was down 10%. Now it's only down 8. It was a really quick drop off, and I don't know why, but point being is, I would let the market kind of set a little bit before you start making positional bets, because right now it's still TBD, especially since the war is not over. All it takes is people to ignore that and start bombing other people and whatever they're going to do. So I'm reserving my opinions for the moment, but yeah, I did want to kind of share that because I think those are important in this market. Really, right now, focusing on earnings, focusing on correlations, what areas are related to what is moving, what's not. Is the whole energy sector going down, but this one stock is going up? Well, that's a stock you might want to pay attention to. So it's just important to think about this in a broader picture and don't focus on the day-to-day stuff, because we've certainly seen a lot of changes. Also, keep in mind that I've shared this in the past, or a version of this, is that this is year 2 in the presidential election cycle, and this is typically the weak period. But as we look at this next period from pretty much May until October, it's generally pretty flat. Now we could see it go up, which is a normal kind of a Trump. If you look here, the Trump presidency years, you definitely could see this pattern accelerate, but you just want to be cautious because this is a midterm, and we really don't know whether Trump is going to be, if they're going to try to impeach him every other day for false charges like they did in his first term, if the Democrats win. Now, if they're, they've got to win, the House and the Senate. We'll see. We'll see what they do, or if they split it. Either way, there's going to be a lot less. It's not going to be as easy for Trump the second 2 years as it was the first. So he's going to want to do the best he can to help his party keep some seats. So I'm very curious to see what's going to happen. Everyone's predicting what's going to happen, and I'm very curious if that's going to take place or not. But typically, you have midterms which are kind of lackluster in the middle. So I would just keep an eye on this, just as a point of reference. As don't expect too much of the markets. If you expect the markets to go up 20 or 30% from here, I think you need to set your expectations a lot lower. And a lot of smart people I know are caught off sides with this in the last 2 weeks, and they're just like, yeah, we missed it. It's okay, which is fine. It's okay. You don't need every second of the market to be in and to be in the exact right place. It's okay, right? You can sit in the sidelines sometimes. There is a point you're going to want to get in, but just keep in mind, don't feel the FOMO, right? You're not competing against other people. You're competing against yourself. Keep that in mind. What other people do really don't matter. It's only what matters is what you do. So, Doug, back to you.
Yeah, we'll try a couple things today. So just for those listening, we've got, trying some new technical things. I'm actually sharing some stuff today. So I'm going to go through some things that back up exactly why what you say about this market kind of going into, to the moon is something where people should have some caution. So first of all, so I'm sharing a chart right now. Basically this comes from the International Monetary Fund. The International Monetary Fund is basically done some updated projections, 2026, 2027, that's showing that the global economy is going to continue to face renewed tests as the war of the Middle East threatens to disrupt growth and disinflation. Um, so it's so what they basically said is withstanding higher trade barriers and elevated uncertainty last year, there's now a new major test from this outbreak of war in the Middle East. Assuming that the conflict remains limited in duration and scope, and again, I know it's paused, but we all know we all know that we don't know what we don't know. Global growth is projected to slow now to about 3.1% in 2026, 3.2% in 2027. Global headline inflation is expected to rise modestly in 2026, but they're still expecting a resumed decline in 2027. Let's call these predictions sure to go wrong. The slowdown in growth and increase in inflation are expected to be particularly pronounced in the emerging markets and developing economies areas. Downside risks are going to continue to dominate the outlook. Longer, broader conflict, if it comes back, worsening geopolitical fragmentation, reassessment of expectations surrounding artificial intelligence-driven productivity, and renewed trade tensions could, surprise and continually, significantly weaken growth, further destabilize financial markets. Elevated public debt is a real issue. Eroding institutional credibility further heightens those volatilities and vulnerabilities. At the same time, activity could also be lifted if productivity from gains from AI can finally materialize more rapidly, or trade tensions can ease on a sustained basis. So right now, obviously facing some growth, some growth concerns. In the developed world, as you can see on the chart, still looking as a major positive for the United States. We're looking at a projection of a 2.3% real GDP annual percentage change in 26, 2.1 in 2027. If you look at other developed countries there, Spain is the only one. Well, Spain is the only one listed that is over a 2. There's other advanced economies that are throwing into that are hitting higher 2.6. But you can see that emerging and developing economies, there's although they're seeing an erosion, you're still seeing that areas like India and China, they expect the highest GDP growth in those areas. Otherwise, emerging and developing Europe, certainly seeing a much more tempered increase in the GDP growth that's going to happen in those areas. I also want to, and I'm going to figure out how to do this right, but I'm going to stop sharing for a second to pull something else up. But what we've got here also is I want to kind of go through some different charts that are coming in from in this case, this was actually coming from a group with the Federal Reserve Bank of San Francisco. So starting with the oil prices, let me grab that up here real quickly. Give me a second here. Okay, perfect. I'll bring that over and share. What we are looking at with oil prices is that we're actually going to starting to see, and I'll get that sharing here in a second here, Kirk. There we go. Is that we're actually starting to see that the oil prices are high. They expect them to remain volatile. You can see that the spot price at the start, prior to the start of the conflict, we were looking at a spot price that was just around 70. It spiked up to to 100, and then of course through the conflict spiked up to 120. It's now come back as of the date of this chart, which was April 13th, just under 100. So that that of course remaining volatile is going to continue to create pressures, and ultimately it's also been accompanied by rising costs for political production inputs, including fertilizers, aluminum, helium, plastics. All that latest information from oil futures is going to suggest a partial price recovery in the third quarter of 2026. The duration of energy market disruptions remains highly uncertain. Ultimate independent, economic impact is going to depend critically on how long those disruptions persist. if we look at market-based what the markets expect in terms of near-term inflation pressure from that, what we have is over the next 2 years, inflation expectations, according to the Fed, have climbed since the conflict began. This indicator is particularly informative as investors' financial positions provide a credible gauge of anticipated inflation trends. Near and medium term expectations have risen in response to these disruptions in energy markets. Longer term projections for a 5 to 10 year horizon, those still remain largely unchanged. The relative stability suggests that market participants continue to view long run inflation, as well anchored around 2%. But it's inflation is going to still remain high from acyclical factors, but expected to reach 2% by 2028. So if you take a look at this chart, the current high inflation due to acyclical factors looks like we saw a cyclical and acyclical factors drive up inflation heavily from 2020 all the way up through 2022, starting to come back in 2023. It is actually stabled out here, but the latest readings from the San Francisco Fed's data series show that the current elevated inflation levels are primarily driven by these acyclical factors, which includes goods and services for categories that are more sensitive to industry-specific factors. And while the contribution from cyclical categories, most sensitive to the business cycle, have returned to pre-pandemic levels, the contribution from these other goods and services have been rising. So the pattern suggests that while tight monetary policy and soft aggregate demand are putting downward pressure on inflation, sector-specific factors, things like tariffs, strong demand for semiconductors, have kept overall inflation from declining on net. Now, what does that mean looking forward in terms of where we see the 2% inflation goal? Well, it actually means that it's going to create a bumpy road ahead. What they're expecting, things like higher energy costs are going to exert upward pressure on inflation in the coming months, but they still expect the impact from these factors to largely dissipate in the second half of the year, under the assumption that tariff effects on prices will fade and the oil prices stabilize or recede towards pre-conflict levels. But now they're projecting that inflation will reach the Federal Reserve's 2% goal by mid-2028. Although, again, there's considerable upside risk to this. The projected inflation path, given high uncertainty around the duration of the conflict. And again, this is where we don't know what we don't know, and any conversation can change that. But right now, they're projecting that inflation to rise by approximately 3% by the end of 2026, before declining gradually towards 2% in 2027. Now, the problem that we're facing and that they're concerned about is that is going to be in line with weak job growth. Okay, so if you have if you're see a labor market that is dealing with higher prices, we are now in a cooling phase that we went into a nice rise in monthly change from income coming out of COVID, the demand for labor. We are now in a sustained cooling phase marked by moderation in monthly job gains relative to outsized gains that we had observed before. So while the job growth has slowed considerably over the past year, the unemployment rate, thankfully, has remained relatively stable. And the lack of any strong upward movement in unemployment, despite small job gains, suggests that the break-even level of job growth, the pace of job gains needed to absorb the labor force growth with an unchanged unemployment rate, is currently quite low. So labor force growth has slowed due to a combination of low labor force participation, but you also have to add in that we have now seen a slowing of immigration, which does contribute directly to that. If we were to look, a little bit further into how that's also being, affected by wage pressures, they are also softening across skill distribution. So we have wage growth, so we've got job growth cooling. We also have wage growth softening. And so you think about that, and as it relates to higher inflation, that has longer term impacts that can happen in terms of GDP, because we're now seeing this wage growth softening in all levels. High skill obligation or occupations have dropped. Low skill occupations have dropped. This is coming from the Atlanta Fed's wage growth tracker. That the pace of wage increases significantly slowed from peaks in 2024. So what does that mean again from an outlook of GDP? Okay, growth is still expected, but as as the world, the International Monetary Fund said, downside risks have significantly emerged. So the growth rate of inflation-adjusted consumer spending slowed somewhat in recent months. Nothing catastrophic. It's coming in at an average of 1.2% annualized over the next 6 months, ending in February. By comparison, though, we had seen that it was growing at an average rate of 3.6%. So that is less than half per month, per month in 2023 and 2024. So that slowdown in spending, again, when you're talking about profits, right, that has a direct impact on that. And that has occurred alongside that softening wage growth, a decline in consumer sentiment, and higher goods and price inflation. If we take a look further that creates new downside risks. Ultimately, the conflict has introduced risks that we didn't have before in the near-term economic activity. So the growth projections for the first half of 2026 got revised down, reflecting the impact of higher oil prices on real incomes and consumer spending. Going a little further on what that has an impact on market cuts, right? The markets had expected. Whoops, I'm showing the wrong one. Sorry. Let me clear that out and get the right one in here. Where did that go? Well, maybe I didn't post that one. Okay, so let me just come back. So the markets actually had expected, as we've talked about before, they had expected rate cuts to occur, but ultimately they're no longer expecting those rate cuts to occur. They had expected that us down at below 3% by 2027. Obviously now they're expecting that to maintain. So when we take a look ahead at other impacts and the things that we're seeing here, ultimately those pressures, when we take a look at oil pricing, going up as it had and holding steady on those prices, that's going to put pressure on, along with job issues on consumers. And so I think as we're looking at the profits right now from companies currently, Kirk, expect that we're probably not going to see too much concerning coming in current profit reports. But as we get into the future quarters and we start getting 6 to 8 weeks out, I think you're going to start seeing that hit. And I would be very cautious. And that is assuming that we do not see any further conflict occurring in the Middle East.
Yeah, I think that's a great point, Doug, because a lot of times we want instant gratification, and we talked about earlier in the show about 6 weeks, or so to get a tanker from Strait of Hormuz to around the world, and that delay is going to impact a lot of companies, and it's going to probably start right now for the next 6 weeks. So we're really looking at June. When you really start to see the impacts of this stuff, when that impacts kind of end, and you'd see, here's the thing to keep in mind. And we hear this a lot with bonds. People are like, oh my God, there's a whole bunch of bonds going to come due this year and the government's going to default and blah, 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 blah. Okay. So we know that there's this delay in the market, right? In goods getting to where they need to be. We know that people are overpaying for oil because they have to keep the lights on. We know all this stuff. The market knows it. That's how the market prices. That's why the market sold off and why it's coming back. The market's coming back. It doesn't mean that later, oh my God, things are going to be crazy and the market has no idea in 6 weeks it's going to be nuts. No, the market already knows that. So the fact that this is, the pig is going through the python right now, what we need to keep in mind is that the markets operate as a discounting mechanism for the future, usually about 6 months in the future. So the market already knows 6 months from now, everything's going to be fine. Yeah, sure, prices are going to go up. We're going to have inflation. We're going to have more inflation than we would have otherwise. some companies are going to struggle, some countries are going to struggle, and some people are going to struggle, right? Because we all know gas prices are up. You're in the fours. I just got an email from heating oil company that we get, and it was like, oh, the Strait of Hormuz is open, and it showed like the daily prices, and it was like 4.5 per gallon. I'm like, what? That's nuts. But anyway, so the point is when you're looking at these things, some things get instantly impacted. Most things drag out over time. So we're definitely going to feel it. Earnings are definitely going to suffer. But honestly, by the time it comes out, so you're looking at the end of Q2 earnings, they're like, oh yeah, that war really impacted the earnings. I think you could start to see a lot of companies throwing the baby out with the bathwater, like, oh, it's terrible. We got all this stuff and it's awful. And a lot of companies in the earnings, they're already talking about like, the impacts of different things. Now, the financial companies, the big banks don't seem at all concerned about the private credit problem, which is still a problem, by the way, but they don't seem as concerned about the private credit problem. And, so we'll see, right? And tech companies, are they concerned about AI? I don't know. We're going to find out soon because earnings are coming up and companies are going to start talking about the problems. And but I suspect next quarter is when when the bad news will come out, because they can throw all the bad numbers over together. And some companies have already started to align that, and they've already started to guide in certain directions. But you think about companies like airlines, you think about companies like transportation companies, they're going to be impacted by oil prices for sure. Now, we didn't get as impacted as global companies. I wouldn't want to invest in like a FedEx of any other country because I think they're all going to be impacted, or an airline. But we're in better shape, but it's still up a lot. I mean, gas prices definitely doubled here, even though we're not as impacted because we have plenty of fuel domestically. But globally, there's a lot of arbitrage going on, and anyway, so all that to say is there's a lot of changes that are going to be happening. We'll certainly touch on this next week. We'll see what happens. The market seems to think everything's hunky dory and all set and ready to go, but I'm still keeping reservations as we go because I think it's you can react quickly, but things could change very easily. So, but it does feel like things are kind of moving on, and the market has kind of, for the last 2 weeks, not cared much about what's going on in the Middle East, even though prior to today we were hearing reports of the war still going on, people are still being attacked, all this stuff's happening. I was hearing a lot of reports of that, and maybe that stopped. But even though we had a ceasefire, my understanding was we were still at war. So we'll see. The market doesn't seem to care. Everything, bad news is good news again. Good news is good news. So the market doesn't seem to care. So that's just something to keep in mind. Doug, wrap us up here. We're at the hour.
So, sounds good. So I'm just going to a couple quick things here. I forgot to share this one. I think this is a really telling thing for people to think about going into what we just went through. And I don't think it's a surprise to anybody that energy is absolutely, it just trickles throughout our system. And when energy costs are high, it impacts long-term growth. But here's a chart by JP Morgan, actually, that shows it very, very clearly that other than in September 1999 oil shock, where after in the months leading up to the shock, the actual growth forecast of the in general consensus for 1 year forward GDP actually remained positive. For every other example they have on here, and you can see that there's about six examples, they all remain negative. So they all ended up declining and remaining negative for an extended period of time, up to 6 months after. That's at least where with the chart they were looking at. This comes from Bloomberg. But ultimately, the abrupt shutdown of the Strait of Hormuz in the Middle East did jolt the markets. It did send oil prices up. And that ultimately, when we look at the 1 year ahead GDP forecast, they typically decline on average roughly from 0.5% to 1.5%, following sharp oil spikes reflecting tighter real incomes, weaker consumption, and reduced activity energy sectors. Now, one thing that has been a pattern that we have seen over the course of generally is that overall oil dependence over the entire world has been declining pretty steadily since the mid 1970s. This comes from World Bank and Goldman Sachs Global Research. Ultimately, if we take a look at where it spiked out around, in the middle of, the oil crisis of the mid 70s, ultimately energy intensity has dropped consistently over the course of those last, 40 to 50 years. That leads me to something that I want to kind of ask you about, just a little bit of a question for you, Kirk, before I close this up. We've talked about this before. And when it comes to U.S. power sources and actually looking forward to AI demand and looking forward to what we already know through these data centers is going to be an increasing level of need for us to have energy sources that can run consistently, produce power most of the time, where that is to be dependent. What do you think is the number one energy source that, in terms of consistency, that that you can rely on, being able to know that it's going to be there to meet demands?
Because I've been talking about it on the show, and so have you. Nuclear.
Absolutely. Where and so let's just put it this way. There's a number of different ways you can get money from. Before I show this, you can get money from nuclear, geothermal, biomass, natural gas, coal, wood, hydroelectric, petroleum, solar, wind. Where do you think common energies, petroleum, solar, and wind, rank on the list of consistency in terms of energy and power sources?
Last.
Absolutely 100%. And I'm going to actually share that right now with everybody so they can see it, because I threw it in here. But interestingly enough, you hear about the need for us to increase solar. You hear about the need for us to increase wind, and all of these wind turbine fields and all of these solar cell fields that are out there. But the reality of it is the inconsistency of their ability to run consistently. Wind, and solar still depend on certain weather conditions to generate electricity. Battery technology is absolutely increased, and it's increasing exponentially. Interestingly enough, petroleum, for the use of steam turbines, is right there at the bottom. But what I found interesting is that nuclear shouldn't be a surprise to anybody. Neither should geothermal. I mean, the Earth is going to Earth, right? And if anybody knows anything about Iceland, Iceland consistently, has one of the best energy production on the planet, because they're basically sitting on a volcano. Houses actually use steam to cook, to heat, to do everything. Geothermal, the Earth is not going to turn off. But what I found really interesting is that, you start thinking about common things we think about: coal and natural gas. Biomass comes in at third, the most consistent, source of energy out there. And even before we get down to coal, you can add wood and natural gas above that. So, I think it bodes the question, and I know we're starting to see some things come back around using nuclear, but it bodes the question: are we putting our focus in the right places if we're really truly concerned about being efficient on where we get our energy? And I think people listening know where we stand in terms of politics and profits and and the spin on these things. But clearly, if we are truly concerned about efficiency, maybe we need to rethink where we're getting where we're focusing. I mean, the United States, for example, Kirk, we sit on arguably the biggest volcanic activity in the entire planet. Where is that? Out in Montana. We're based, that whole entire area of that national park is a volcano. And yet, as the United States barely taps it. So I think this is, interesting. We are seeing oil demand.
We gotta wrap it up here.
Yeah, okay. Anyway, I'm closing that down. I mean, I was moving on, but ultimately that is where we see it. So I'll just close this down real quickly. Look, the markets have been celebrating. The data this week tells you something different. Inflation moved higher. Growth is already slowing, and I think the projections say that it's going to, as long as oil stays high. Energy systems are strained. Things don't reverse overnight. The markets did. And that's where the opportunity and risk sits right now. So when the markets move faster in reality, they create gaps between price and fundamentals, between confidence and conditions, between what's expected, what happens. Emergent advisors who focus on navigating the gaps, mapping everything, income, assets, liabilities, taxes, college funding, retirement income. Your strategy then can hold up whether the markets are ahead of reality or reacting to it. It isn't about predicting the next move. It is about being able to be prepared when the market has to reconcile with the real world. If you want to see what it actually where you actually stand, visit us at mergentadvisors.net, MERGENT, mergentadvisors.net. Start the conversation, because in markets like this, the biggest risk isn't fear. It's when confidence comes back too quickly. We'll see you next time.
Great. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.